The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is The Answer About Money. The station is The Answer, and we're talking about money. So here we're broadcasting for the first time. It's Saturday at 12 noon, and I hope that everyone who was listening to us on KKOL is joining us here on this radio program. We'll see. Pardon me. You know, I licensed as a financial advisor back in June of 1986, only we weren't called financial advisors in those days. We were called stockbrokers. And the reason we were called stockbrokers? Well, let me tell you the story behind that. Back in the 1920s, as Seattle was really booming, as the country was really booming, people weren't called stockbrokers then either. They were called customers men. Those were the people that would do local stocks and bonds and mortgages. Fewer stocks than mostly bonds and mortgages. And that was a time in Seattle when you had the emergence of the boy millionaires, who were called the boy millionaires because there was suddenly an explosion of wealth in Seattle. And the customers men knew their customers. They researched the stocks, they researched the bonds, they researched the mortgages, and a lot were local. And the firms were small back then. But at that time, as everything kind of exploded into the 20s, leading up to the crash in 1929, firms began to merge, they began to grow. They weren't governed by the federal government. They didn't have regulations and rules like we do today. And then came the crash of 1929. And the Great Depression. And in 1932, the great legislative act that was passed was the 1932 Securities and Exchange Act. Very similar in a lot of respects to Dodd-Frank and the kind of reception it received then, but established regulations for brokerage houses and for the people who worked for those brokerage houses. Those customers men were not customers men anymore. They became registered representatives of brokerage firms, a title that continues to exist today. That's really what financials advisors who fall under that act are, registered representatives. But at that time, what they did, what the big firms did, is they acted as intermediaries between buyers and sellers of stocks and bonds. Brokerages. That was a brokerage. And those registered representatives who worked for them got the title of stockbroker or bond broker. That's what they went through. And they had to go through some qualifications to be called a registered representative. Those registered representatives, those stockbrokers, over a period of time had to take a test and pass the test to become a stockbroker. At the same time, in 1940, the Investment Company Act was passed, and that began to regulate mutual funds and some non-brokerage firm type people. You know, and sometime after World War II, as we're going through this whole history thing, sometimes after the 1940s, brokerage firms began to shift emphasis, whereas as customers men, as the early stockbrokers would do their own research, would find out about companies, would then take that to their customers, their clients, the big firms began to realize that they were hiring these people to do something besides do stock research. They wanted to create an independent stock research department and turn their stockbrokers into glorified salespeople. The idea was that the stock research department could do things in greater detail and earn their funds, and that the stockbrokers could go out and gather the money to buy the stocks, mutual funds, and bonds, and whatever investment products. Josh Brown, who you've probably seen on CNBC, wrote a book called Backstage Wall Street. And one of the quotes from that book, I think, is exceptional. He said, and it's a quote, "Most of the brokers I know and have met over the years are phenomenal, world-class salespeople. But a great many of these security selling savants don't attain the knowledge necessary to actually accomplish anything for the clients. Selling one's expertise is much easier than actually developing an expertise, especially as it pertains to investing." That comes off page 65 if you want to know where the exact reference is. Investment management left the stockbroker and went to the firm. And then came the crash of 1987. And in 1987, there was a survey that was done that showed the least respected occupation. The worst occupation to have was that of a stockbroker. It rated significantly below used car salesman. Think about that. It was the very worst occupation you could choose. And the brokerage firms in 1987 saw their revenues collapse because people quit trading. And they had to find a way around that. And in 1987, the end of 87, the beginning of 88, we began to see different titles appear. Financial consultant, investment consultant. And finally, they settled on financial advisor. That's how we got to be financial advisors. Did the job change very much? No. But it's important to understand because this is the fifth in the series of what's wrong with financial planning. The first issue was the forecast of whether the client was going to have enough money. And that was based on the Monte Carlo simulation, that bell-shaped curve. And I talked in the first series that doesn't work. The market returns are not bell-shaped, But so that's the first issue I talked about. The second issue is looking back, garbage in, garbage out. Depends upon what data you put in and where you base it. And if you put in the wrong data, you're going to get the wrong results at the other end. That was the second issue. The third issue was confusing short-term risk, short-term volatility with long-term planning. Trying to do an asset allocation so that you minimize volatility can eat into returns. It is the old thing of if stocks return 9%, bonds 5%, and cash 1%, when you add those together, if you do 1/3 in each one, you get 5%, which over a short period of time reduces volatility, but over the long term cuts returns. 5% over 25 years will cut a nest egg in half. That's significant. The fourth thing is the issue to execute the plan, because the financial advisors were trying to do the best they could, but the vast majority had a situation where they were relying on someone else to do the management. So the fifth, the one that I want to talk about today, is diversification. I believe there's some problems even with diversification. There's two sayings that we hear most of the time. Number one is don't put all your eggs in one basket, right? The second one is attributed to Mark Twain, who said, put all your eggs in one basket and watch the basket. I believe both of those are correct. And how can they both be correct? I believe that the less people know, the less the client, the advisor know, the more diversified someone should be. When I licensed as a stockbroker, as a financial advisor, we weren't financial advisors in those days, we had criteria to meet. We had to generate, once we licensed, we had 6 months to generate $25,000 in commission revenues. And those were the days of commission revenues, not fees. You had to generate $25,000 in 6 months. If you didn't do that, you were either fired or the branch manager could override that. But if the branch manager overrode that firing, then the branch manager had to pick up the cost of the training and your salary and the other things that went on. So almost everyone who went through that made it through the $25,000 or were terminated. So that was the first criteria. Then, in the next 12 months, so by the end of 18 months, you had to have generated $100,000 in gross commissions, or you got terminated. And if the branch manager overrode that, he had to pick up the entire training cost and your entire cost for 18 months. Not many people who didn't produce $100,000 in that year made it through. Not many at $25,000 made it through. So, as we went through that process, in the training classes, in talking to different financial advisors and talking to stockbrokers, they said you can't make those numbers unless you do mutual funds. In those days, mutual funds paid 4% or 8%. They paid very well, and you had to put people into mutual funds to make it. I made my $25,000 doing mutual funds, and I said, if I have to do mutual funds to make my $100,000, I won't be in the industry. So after 6 months, I quit doing mutual funds. I started doing stocks. That was a big change because very, very few of the people that I went through training with were doing the same thing. We're coming up to a commercial break. Don't go away because I want to finish this story. I think it's important for you to understand everything that's wrong with financial planning. And we're coming back to this. And I've got a great guest. We're going to talk about another side of the industry, which you should hear about. We'll be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about the background, why we're called stockbrokers, why we're called financial advisors. I mentioned that during the first 6 months after I licensed, I had to get $25,000 in revenues, and then during the next 12 months, had to get $100,000 in revenues. And I made the decision to do stocks rather than mutual funds. That was a pretty bold thing that I did. Because when I look back on it now and think about all the training we got, I mean, we went through 2 weeks at San Mateo, 2 weeks in Seattle, 2 weeks in San Mateo, 2 weeks back in Seattle, 2 weeks in San Mateo, and then we were considered trained. And that was after we licensed, because if you didn't pass the test, you were terminated anyway. So there was a special training office. There were 41 people in my class from around the West Coast, all the way to the Mississippi in my class. And we worked from 8 a.m. until from 7 a.m. until 6 p.m. and sometimes 8 p.m. a day. And what we did is we cold called. That was our training. 5 days a week, and sometimes 6 days a week, from 7 a.m. until 8 p.m. on 3 or 4 days a week, till 6 p.m. on a couple days. And there were 4 trainers, 41 in my class, and what they would do is they would sit and listen to you make cold calls, and then come back to you with suggestions on how you could improve your cold call technique. teaching you how to overcome objections. If somebody said, no, I don't want to buy a stock, I don't want to buy this mutual fund, they would talk to you about how you could overcome the objections. In that whole period of time, think about it, 6 weeks, working 50 to 60 hours a week. During that 350 hours that we put in, 350 hours, we got 2 hours of training on how to choose a stock. 2 hours out of 360. Almost the entire thing was devoted to how to make cold calls. That's the training we went through. And so the fifth thing about this whole idea of financial planning and what's wrong with it is financial planning teaches people to rely on outside investments, mostly mutual funds, but they rely on asset allocation, mutual funds, they do annuities, they do all sorts of different things, but things over which they have very little control. You know, in theory, you look at what index funds are, and The Economist just did an article that I just read this morning, in fact, talking about the index funds and how changes need to be made to keep them up with the index fund. And those changes create commissions and create changes in the index itself. And there's a number of stocks that are first IPOs and then come into the market, which are not part of the index. And that's a part of the market which probably has the most growth of all. Add to that the fact, as we go through this period of time, if we're coming up to a period of time of inflation, there's a lot of talk about inflation today, and my prediction is we have a very high probability in the next 15 years of going through an inflationary time like we went through in the 1970s. And I've given a couple programs on why I expect that to happen. Index funds, if they're indexed to the market was down 40% during the late 70s. 40%. If you're in an index fund that reflects the market, you're going to be down 40%. And yet there were segments of the market which actually did well. That is where we're coming from in terms of putting together portfolios, putting together financial plans, and selecting index funds or even actively managed funds to make the financial planning work. I believe that's very diversified, and that is an issue. I believe that's necessary, however, for those people who don't know very much about what the investments are that they're putting into client portfolios. It's back to that philosophy of don't put all your eggs in one basket. But I believe that there is a way to circumvent that, and that's by putting your eggs into one basket and watching the basket. In 1978, there was a paper that showed concentrated portfolios outperform. I didn't see that academic paper until the early 2000s. But I came to the conclusion through my math background and by game theory that I wanted to do concentrated stock portfolios of 8 to 10 to 12 stocks. By the 2000s, as we went through the dot-com bust, there were a number of academic studies that were done in the years following the dot-com bust that showed that concentrated portfolios actually do better on the average. Today, there's over 200 papers, academic studies, that show concentrated portfolios outperform. So back to the question, it's not put all your eggs in different baskets. It's put all your eggs into one basket and watch the basket. I believe that's one of the faults of financial planning, is it's trying to spread things over such a wide range that you can't achieve the performance that you need to achieve. It forces clients to save more, to give up more today, to be able to have the funds they need in the future. You know, recalling where we are, the 5 reasons. 1, financial planning is based on Monte Carlo simulation. I don't believe it's accurate. 2, when you put garbage into the program, you get garbage out. 3, when you focus on short-term volatility, you give up long-term returns. 4th, when you put in and execute incorrectly, you end up with poor returns. And finally, by being over-diversified, you also end up with poor returns. The result, I believe, is something that's inaccurate, it's unreliable, and underperforming. It forces the clients to save more, to give up what they could be spending and enjoying today for the future. For most people, that's okay, but I don't believe it needs to be. Anyway, I want to wrap it up. I'm going to come back later in the program. I want to talk about what I do. I don't very often talk about what I do, but I'm going to talk about this idea of concentrated portfolios and how I build a portfolio. But I want to stop. I have a guest I think it's very important to understand, and he's a person I've known for a long time. I've known his qualifications, and if you happen to need a securities attorney, I highly recommend John Bender of Ryan Swanson. Well, welcome to the program, John.
Well, thanks a lot, Mike. I really appreciate the time you're taking with me today.
So why don't we start with your background?
Well, I've been doing this, representing folks on both sides of the securities markets for about 35 years, and looking at problems in the marketplace, whether it's stocks, bonds, or whether it's employment relationships in the broker investment advisor space, or whether it's defending brokers and folks from the Department of Financial Institutions, the idea, a whole package of services around the securities industry. And I have a pretty good perspective of what goes on and why the business is changing, and some of the changes are good and some of the changes are bad, but at the end of the day, it always gets better.
Hopefully it always gets better. So let's talk about some of the things you're seeing happening today.
Well, there's a tremendous amount of emphasis on the fiduciary standard right now, the theory being that brokers and investment advisors and financial planners, because sometimes they can be three separate things, have to work on behalf of the client and cannot worry about things like commissions or self-interested income issues like winning contests for free trips or things like that when the client's portfolios are being moved quickly in order to generate commissions and things like that. So what happens oftentimes is that when you're looking at a portfolio these days, a lawyer like me looks at it from the perspective of what did the client say they wanted, and if they wanted to be speculative and aggressive, then there might be one kind of trading that's going on, but if they wanted to be extremely conservative and didn't want to be risking more than 10% of their portfolio, then you have to look at what's happened as a result of that. So in the old days, you had some stock brokers were called stock jockeys, and the reason why was because they fell in love with a few stocks and they ran them to every account that they had, hoping they could sell a lot of it. These days, there are very few of those because most of the big houses now pay their significant commissions on assets under management. In other words, if a broker has a $50 million under management, then they're going to get compensated on the fees they're generating from that and not by commissions. In the smaller brokerage houses and in independent contractor brokers where they have a small office, oftentimes they get paid on commissions as well. But there are all kinds of different pay schemes, just as there are all kinds of different marketing ploys to be able to develop client bases. And at the end of the day, a good client with money to invest needs to have an understanding of how these things operate. And the changes in the industry are so dramatic right now that it requires you looking at whatever basket the broker is talking about very carefully.
We're coming to a commercial break here, so don't go away. We're going to talk about some more of the specifics. We're going to talk about how you can think about your portfolio. Are you achieving what you need to achieve? And if you really do have a problem with your financial advisor, we're going to come back and talk about that. We're going to talk about some of the things that are happening in the industry, because John is the expert. You'll be hearing that. So don't go away. We've got more to come. And if you miss any part of this program or any part of the other programs, you'll find them in podcast on our website adamsfinancialconcepts.com. You can also like us on Facebook. You can like us on Twitter. We tweet during this entire show. Sarah's doing that now. So anyway, we'll be back right after the commercial break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with John Bender of Rand Swenson. He is a securities attorney, been in the business for 30 years, and is an expert. Someone that if you have a loss in your portfolio, you should contact. I don't think many people with profits in their portfolio come to an attorney, but with a loss, especially in these days, I think that they need to talk to you. So let's talk about that.
Oftentimes what happens is that somebody doesn't understand what's going on in their portfolio because they don't know how to read the portfolio or the account statements. And at some point in time, there's going to be a discussion between the investment advisor about the problems that have occurred in the portfolio, and then there's a reason for that. And that doesn't make any sense because all the investor has ever heard about in the last 3 years is how well the market's been doing. And that's when a second opinion's required. And most people end up not knowing what to do. And what to do is call your accountant or call a friend who is in a bit of the know about financial things and talk to them about it just to get a different opinion. And usually that'll give you a direction about what to do next. And then the next thing to do would be looking for an attorney who is experienced in the area. And this is a very unique practice area, and it's difficult to find folks who know much about it. There are only 6 or 8 people in the entire Northwest who do a lot of it, and 2 of them are in my firm, and we handle a ton of cases, whether they're on the investor side or on the defendant side, looking at them from the standpoint of, first of all, trying to get them resolved if there's a case without having to go to an arbitration process, which is required in most cases. But if that's necessary, then we move through that process. And it's all a function of what you told the folks you wanted and what you ended up with. And if you told the investment advisor that you wanted to speculate, well, that's what that you're going to have to take the losses probably, unless the strategy was so crazy that even that wouldn't fit a speculative investor. But if you tell the investment advisor you want a conservative portfolio and it was a very aggressive portfolio, then there's going to be a claim there. But you need somebody who knows what it's supposed to look like before you can come to a conclusion about, for the lawyer to come to a conclusion about whether to move forward.
And I want to come back to that. You mentioned there's 6 or 8 attorneys that understand securities law. Securities law is very, very specialized. It's not something that you can go to somebody and says, oh, he's an injury attorney, he can handle it, or a real estate attorney can handle it. This is something that's very, very specialized.
Well, there are a lot of securities lawyers in the sense that they do securities, raise money for clients, but there are very, very few, as I mentioned, securities dispute lawyers who handle client disputes that are handled not in court but in an arbitration forum, and that are handled according to different rules. There's a lot of it out there that shows up, especially when the market goes down. But sometimes when the market's going up, as we just talked about, where someone's it's just not happening, and there's got to be a reason for it. And sometimes that reason is because there's a commission-driven motive that basically sucks the gains out of the portfolio. And that's the concern that we look at very quickly. And there are people who have a hard time understanding that, but we see it very quickly.
There's a potential for people who have been living now with very, very low interest rates and very low yields on bonds to have stretched and looked for things which have a higher yield.
Sure, and that usually means if they're wealthy, have over $1 million in net assets, that they may look for private placements or other kinds of investments that are outside the normal the normal area of stocks and bonds in the public marketplace. But that exposure to risk brings the kind of risk where you can lose all your money. In fact, it says so on the documents that you're going to be looking at before you sign on to such things. Also, ideas of options strategies or programs that will assist you in geometrically increasing the potential gain also have a potential for substantial loss. Those get more, the more yield that you're trying to grab, the higher the risk generally, unless you're in something like Netflix or Apple or things like that, where you are willing to leave your money in there for the long time for the long-term gain.
We're seeing a number of places now which are really pushing hard on ETFs. And we're seeing ETFs which have triple leverage.
And those are very exciting for the investment advisors because they have something new to sell. But you have to be very careful with what portion of your money is going to go into an ETF, and you have to really understand the risk. Remember, you don't have anything inherently valuable when you buy an ETF share, because all that really is there's funding around whether the market is going to go up or down, and if it goes up, you make money. If it goes down, you lose money. You don't own anything of any value that you could use to sell and generate a lot of yield off of. The ETFs are designed specifically for a moving market, not a stable market.
And what we just saw with this downdraft in the last few days is people having a very difficult time to get out of ETFs because there's a problem of liquidity.
Well, and that happened in the same kind of a way back in 2007 and 8 in the many mutual funds and especially real estate based funds that they couldn't liquidate their holdings fast enough to pay off clients who wanted to get out. And so those are the things you worry about when you don't have a unencumbered equity or unencumbered bonds, which have essentially the value that's assigned to them that are in the marketplace.
So I want to come back to this thing of yield, because you mentioned high net worth people, but there's a number of people that have $300,000 or $400,000 that have put their money into things that are yielding 6% and 7% and 8%. And a lot of those, I would imagine, will be going south at some point.
Well, it all depends upon what it is. I mean, if it's a municipal bond for a solvent city that's generating a 6 or 7% over time, then the chances of that happening there are less. But oftentimes, things that might be akin to junk bond status really do depend upon that company's positive effect in the economy, and oftentimes those go south even though they're paying more than the market would otherwise want to pay. And the same problems occurred back in 2007 and 8. The same kind of thing. People were trying to chase yield and buying stuff that was extremely risky, and ultimately the yield never came because the market went south.
We're seeing things like people putting funds into things like factoring.
Sure. Well, these are a classic fraud scenario when you see these things happening. There's a Brazilian factoring fund that came out of basically a couple of sophisticated Miami business people who ultimately are defending criminal fraud charges because all they were really doing was lining their own pockets. But how do you know about that ahead of time? And the answer is that you have to talk to somebody else besides the person who's trying to sell that to you. For an example, the Brazilian factoring scheme, the folks who were selling that were unlicensed insurance agents, well, they had license to sell insurance, but not securities, and the folks were telling them they didn't have to have licenses to sell these securities. And that's who sent out $150 million of this stuff, and all the money's gone.
And the money did not go to the investors.
Right. The money ends up in the hands most of the time of the folks who form the investment, because they forget the fact that it's not their money. And that a couple of other folks that this happened with back in the 90s, the Stephen Hoffenberg Towers financial debacle. These were promissory notes sold through small broker dealers, and those folks they went bankrupt, lost money, and Stephen Hoffenberg went to jail for 20 years, and he just showed up again in 2016 as a PAC sponsor for then Donald Trump running for president. He was not allowed to raise money, though, because of his conviction. And then more recently in the Seattle area, Darren Berg, the real estate securities guy, he generated many hundreds of millions of dollars, and most of that went to him and his the stuff that he wanted to spend money on, and ultimately he ended up in jail, but has recently escaped.
So anyway, if you think that you have a portfolio that may be losing money, or maybe you have a claim, you should contact John Bender. Ryan Swanson. What's your phone number, John?
My direct line is 206-654-2209, and you have and I answer it if I'm there, and if not, leave a message. I'll be able to take it. Or you can reach my by email at bender@ryanlaw, ryanlaw.com.
So say the phone number and contact again.
206-654-2209 and bender@ryanlaw.com.
So do that. If you have any questions about your portfolio, do contact John. John is one of the very few in Seattle who handles these things, knows what to do, and will handle you very, very well. Thanks for being on the program, John.
Thank you very much, Mike. Really appreciate it.
We're coming to another commercial break. When we're done with this commercial break, I'll come back and talk about how I structure a portfolio, just as one of the information items. So don't go away. You'll find a lot of that information as well on the website, adamsfinancialconcepts.com. Check out our performance, check out what we do, check out frequently asked questions. And I'll be back right after this commercial break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm back again, and we are live on KKOL. We'll be on the program tomorrow from 3 to 4. We'll be on Saturday, and we'll be on Saturday KKOL from 5 to 6, and KFLE at 12 noon. So anyway, you can find us anywhere on those stations. So anyway, the question is, how do I manage portfolios? I haven't talked about this much at all. I come with an understanding and have been doing portfolios for a long time. It begins by talking to the client about their objectives and risk tolerances. That's pretty standard stuff. And yet, I've found over the years that when times are really good, clients tend to be more risk tolerant. And when you're suffering through a 2007, 2008, they tend to be risk adverse. So I try to get down to where a person really is. The second thing is I do my own research. I don't depend upon research departments. I don't depend upon other people doing the financial stuff. I look at 30 to 40 stocks per month. When I say 30 to 40, a few of those I will look at 3 or 4 times a year, but I look at a lot of stocks. And usually it's a cursory glance to get some idea of what the stock is, know where it is, what's going on. And then I will actually take time to drill down on 8 or 9. I read 2 to 3 daily newspapers. I read 23 magazines. I read 1 to 2 books a month. All of that looking for stock ideas. So when I do drill down on the 8 or 9, I have a pretty good idea of what those companies do and get a preliminary idea of what the stock price is and whether it makes sense to look at it as a real candidate to add to portfolios. I probably look at 1 to 2 in great detail. Read the 10Ks, look at the 10Qs, look at the information, their product library, if they have a product, look at what they're doing, looking at the growth, looking at everything I can find out about them. 1 to 2 a month. Out of those 30 or 40 that I begin with, it comes down to 1 or 2 a month. And then I take all those things and I only do 1 or 2 trades a year. You know, I'm not a trader. I truly believe, I think it was Warren Buffett that said you cannot make a baby in 1 month by getting 9 women pregnant. I'm not a trader. John Vogel of Vanguard Funds said, over 80 years old, been in the business for 60 some years, said he's never known himself nor known of anyone who did as well as the market by market timing. Traders. I am not a trader. I do 1 or 2 trades a year. You know, some of my stocks, one of my stocks in my client portfolios has been in client portfolios for over 20 years. A couple lasted more than a decade. A few have lasted fewer than 6 months. I made the decision to look at the stock. It seemed like a great buy. After 6 months, I realized I'd made a mistake and I moved it out of the portfolio. But if you look at all my portfolios, if you look at over 100 portfolios, you'll find that in all of them, there's only 16 or 18 total stocks. And it's concentrated. If you look at any one portfolio, you'll find 8 to 12 stocks, leaning more toward 8 than 12. And the way I construct a portfolio, it depends upon the client's objectives and risk tolerances. It will be different percentages of different stocks. So some stocks will only be in conservative portfolios. Some stocks only in more aggressive portfolios. Some stocks in all portfolios. And I look at the stocks in a special way. I look at those companies which have what I call twice the upside as downside. If I look at a stock that's priced at $10, I'm looking at probably something that can go to $20 in a reasonable time period. And a reasonable time period is not a month, is not a year, it's several years. And has a risk during that time of dropping by 50%. So it has the potential to go from 10 to 20 or a risk of going 10 to 5. And I look at both sides of the equation. When I got into this business, the saying was that you had to be right 66% of the time in order to make money. And I thought about that a long time as I was starting to do stocks in that very first year in 1987. I started to look at that and wonder about that. And I thought maybe I should just figure out how to determine which stocks. So that's what I came to. So the illustration I use is if you buy 3 stocks, they're all priced at $10. So you're out of pocket $30, 3 times 10. And one stock can go to 20 and the other 2 fail, go from 10 to 5. You end up with $30 at the end of the time. 1 goes to 20, 2 goes to 5, 20 plus 5 is the $30 you started with. So if you're right half the time, you should make money. And I'm only right half the time. I'm not 100% right. But that's the first principle I start with. The second one came from game theory. And as I thought about this during my first couple of years in the business, I thought there's a way to play this that what is the optimum number of stocks that I can choose? What will be the maximum gain? Is it 300 stocks or is it 50 stocks? And as I thought about it, the idea occurred to me that if you have one stock in a portfolio of 300 that explodes, it's not going to make a lot of difference. So I began to think about it in terms of game theory, in terms of playing a game. So if you have stocks that can double in price or drop by 50%, 2 times the upside is downside. If you're right half the time and wrong half the time, like a flip of a coin, and if you have 100 plays, $100, and there's a couple ways to play. You can bet $1 each time, and the coin flip comes down. You get $2 for your $1 bet. Then the coin comes down tails the next time. You lose your $1, you have 101. If you work that out 100 times, the expected value is $150. $100 to begin with, $150. But if you bet 10% of the portfolio, the expected value is $3,700, not $150, $3,700. If you bet 25% each time, the expected value is $46,000. Doesn't keep going up the bigger the percentage, because you know that if you bet 100% every time, the first time you lose, you're out of the game. So that told me that the maximum number of stocks you should have is 4. But I was concerned about risk as well. And I found that William Sharpe won the Nobel Prize, showing that there's no statistical significant difference between owning 8 or 9 stocks and owning 300. No statistical difference in the risk. You don't gain anything by owning 300 if you have at least 8 or 9. So that's why my portfolios have 8 to 12 stocks. And I vary the percentages and shift around to the client's objectives and risk tolerances. That's how I build a portfolio. I started doing that in 1991. A lot of papers have come out, academic studies have come out in the 2000s to show concentrated portfolios outperform and do not have any more risk. Talk to a lot of financial advisors, they'll say it's high risk. Talk to academics who do the studies, they'll say there's no more risk. Anyway, that's how I build the portfolios. That gives you a little insight into what I do. And I will be back next week to talk more about money. So join me then. And until then, have a great weekend. You can like us on Facebook. You can follow us on Twitter. And it's About Money, Facebook, About Money, Twitter. Have a very wonderful weekend. And I will be back to talk about money next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's Adams